Welcome back to a Thanksgiving edition of Happy Half Hour. That's Toby Weber. I'm Nick Shermans. We'll be talking holidays, markets, economy, data flow, government shutdown, technical problems that we had setting this up.
Baseball playoffs.
Oh, yeah.
Yeah, lots of good stuff.
As I age, I think Thanksgiving is probably my favorite holiday. It's Christmas without all the stuff.
Yeah, the expectations are low that you actually have to do anything. So that's a good holiday.
And there's football. They try to entertain us.
Sure.
So we can sit back, eat meat, and for those that partake in adult beverage, you can do that too.
Sure. It's a good holiday.
So I'm heading to Central Oregon, actually. First time we've been away from my parents, my in-laws, so we're trying something new. Nothing that they did. We just wanted to we're getting older. Yeah, we're getting older, so we rented a house. We're just going to chill. I'm a little worried about going over the mountain because I don't usually make that trek.
I can help you with that.
Okay.
I got some tips.
All right. What's your program for the Thanksgiving holiday?
Going to my sister's place for Thanksgiving. So our whole family will be there. My whole extended family will be there. So when that happens, you get 30 people, 25, 30 people there.
Sounds awful.
Yeah. So all good. Looking forward to it.
Okay. Tell me what you got on your notepad. You've got the old school legal pad there.
I have 6 potential questions. 7 potential questions. So you want me to jump right in and
Sure.
And give you one? Let's just start with the market right off the top. So the market, it's been a little more volatile in November, but still kind of hanging in there. Every time we get a day or two sell-off, it kind of bounces back. The market is expensive. The market's had a really good year after the swoon in April. How do you view the market today? There's lots of doom and gloom out there about where we're at and why we're not, the market is staying elevated. So how do you view this picture and what advice would you have for clients? And again, there's 6 or 7 questions in there for you to answer.
That's 7 questions in one question. So I'll point out some things that are interesting that I'm paying attention to.
Okay.
Because who I am as a human being, how I view the world doesn't change from month to month as we do these podcasts. So I run the risk of repeating myself. But it's interesting to me that investor sentiment and consumer sentiment are basically down in the dumps. And I don't know if this is true, but someone said that investor sentiment was consistent with 2008-like levels. Yet we keep hitting all-time highs. I think we've hit 30-something all-time highs in 2025. And when you back out and look at the data, earnings, we just got through third quarter earnings. Earnings were really, really good. And a lot of people are confused about why the market keeps going higher and they're paying attention to the news and politics. Well, one of the main functions of market movement is earnings. And earnings were something like in the 95th percentile, meaning they beat 95% of historical readings. So earnings driven by this AI investment team have been really, really good. But you can't help but monitor what these CEOs and CFOs are saying on these calls. A lot of them talk about AI, talk about CapEx, talk about the payoff and investment. And it's still the range of outcomes is quite wide, and everything is trading as if any company involved in AI is trading as if it's going to be a winner. As we learned from the internet bubble, it ended up being a bubble. There were winners and losers, and the gap wasn't even close. And again, right now, everything attached with AI is trading as if it's a winner. So there is going to be some separation. No one knows who those winners are going to be. There's early leaders, but that remains the question. And then, one thing that we pointed out, U.S. large caps are quite expensive and many people are overexposed to the AI theme, whether they know it or not. And it's just a good time to rebalance portfolios, take some chips off the table if you have an overexposure to any one theme.
Yeah, the company earnings report that I got a kick out of in the last couple of weeks was Caterpillar, because Caterpillar talked about AI and how what they were doing in AI, and the stock jumped like 20% in that day. And I know Caterpillar from my prior life in the mining and construction world, and Caterpillar is a lot of things, but they're not necessarily cutting edge. And so to hear them talk about AI and then get the boost that a lot of companies are getting was pretty surprising to see. One follow-up for you. If the AI narrative turns out to be false or not as robust as we think, do you think that the market then kind of has an adjustment as a result of that, or will it depend on other factors?
Given how far and fast a lot of these names have come, in my professional experience, it's not going to be a neat and tidy unwinding. It's going to be quite violent and aggressive. And I shared a graph back in our market commentary for October that outlines the NASDAQ's journey when Netscape launched in the winter of 1994 versus when ChatGPT launched in the fall of 2022. And the lines are almost 1-to-1. And one thing I noticed about that, even though the line was moving up and to the right, the NASDAQ obviously did quite well from 1994 to 1999. There were several dips, and they weren't subtle. And that graph kind of peaks in 1999, and then the NASDAQ, I think, lost, 70%, 80% back in 2000. So I'm not saying that's going to happen. Certainly, different backdrop, different economy, different rate environment, different inflation, all that stuff. And then companies nowadays are financing a lot of the capital expenditures through earnings, although many of these AI companies are starting to tap the debt market, which has caused people to raise some alarms. There's been some savvy investors that have started to sell their AI positions. When you add up all of these things, again, we talk about AI a lot because it is driving what's currently happening, and there's a massive trickle-down effect. So, you might log into this podcast or click on this podcast and be like, oh man, you guys talk about the same stuff. Well, as we get more concentrated, the further we go higher, the more there is at stake. And I think that is the question is, will the massive bet in AI pay off? And I know we get distracted with, again, politics and government shutdowns. All of that is ancillary to the question that I just mentioned.
Yeah, and I've seen different theories that, hey, this is 2000, this is 99 or 2000, and people say the end of the world is coming, but doesn't matter. People are disregarding it. They're becoming numb to it. And then I've seen other people say, no, this is 2013, where we might have a little bit of a correction, but the overall trend is higher over the next several years. So the reality is no one knows. We continue to monitor and watch things, and we have a framework to make adjustments to our portfolios. But it's certainly an interesting time, to be sure.
Well, and we've actually taken some U.S. large cap off the table in 2025. Of course, we had the disruption in the spring. So we took 3 to 4% off the table there, added to fixed income. We did the same thing in September. And it has less to do with a hot take about what happens next or anything like that. We were over allocated to U.S. large caps, and rightly so, in 23 and 24. And for the first quarter of 2025, it's been quite good. But we just wanted to rebalance, get a neutral positioning, because history often rhymes, and what's worked yesterday might have a challenging time in the next phase of the cycle, but timing can be fleeting. Another thing I'll add is we both use Twitter. We both have kind of curated our followers for economists and traders and investors. And there's really two extreme camps. One thinks the world's going to hell in a handbasket and they're all in cash or out of AI names. They think it's a speculative bubble. And the other camp is full send, like heavily invested in AI, own the names directly, no end in sight. It's the biggest technological advance in our time. And it's just interesting how people see the world as black and white and hang out on the extremes.
Yeah, the reality will be that you probably both will be right to a certain extent. There will be winners and losers, and everybody will claim victory from that. So
I've got a question for you.
Okay.
Do you notice or pay attention to, and I'm going back to Twitter, but there seems to be a push and pull between financial planners and investment managers, like advisors that are more planning focused versus advisors that are more focused on the investment side. Do you have any comments, or have you noticed that debate?
A little bit, and I get more planner feedback. Maybe that's just the list that I've curated, but I get more planner input, observations, feedback over the investment realm. What do you see in your feed?
Well, it's like you have the planners, the CFPs and firms that lead with planning that really minimize the investment piece. And I think it's easy to do that on the heels of a bull market, right? We've had 13 to 15 years where the market has gone straight up. People are conditioned that is going to be the background. Okay. I go back to the previous decade. I started my career really in 2005, 2006, leading up to the financial crisis. If you invert that, and if you led with planning in the spring of 2009 when corporate bond portfolios were down by 20%, your client would have looked at you like you were crazy. Like, this guy's an idiot.
Right.
So my whole takeaway is it's not the investment managers versus the planners. A modern advisor should be well-versed in both. And to me, there's just so many advisors, younger advisors really, that have gotten in the business and have never seen a difficult market environment. And I think that buy and hold investing is great if you're in your 40s or 30s or 20s. For someone that's retired or about to retire, you need to have an advisor with a process, a framework to make decisions rather than just, hey, I'm going to throw in a bunch of ETFs and call it good. Through our experience, we're a pretty fast growing firm. We see a lot of advisor managed portfolios, and they just leave a lot to be desired. It's either a collection of expensive mutual funds. They don't have a process to manage risk. They don't know how much risk they're taking. They're over allocated to big tech, S&P, QQQ, and then they own the names directly. It's just, there's a narrative out there that the investment piece is solved, and based on what we see every day, it's certainly not.
Yeah, and unfortunately, the only way that gets adjusted is probably through a significant correction that lasts more than 30 days or a couple of months. And I'm certainly not rooting for that, but that's how that mindset changes. Today, it's just buy the dip. If the market goes down 2%, 3%, 5%, well, that's a buying opportunity, and you better hurry because everybody's going to get back in and you have to beat them to the punch. And unfortunately, that's worked beautifully for the last 10 plus years. But at some point, my fear is that doesn't work and it goes down. And this is, you call me a glass half empty guy, but at some point we have a correction and people buy the dip and the market goes down more and people buy the dip. And that's when people can get in trouble. So to your point, having a framework for making decisions when the market is adjusting can help keep you out of a really serious impairment to the portfolio.
And most people, price drives sentiment. And I said that before. When markets are going up, people don't want to hear about what could go wrong. They don't want to hear a certain asset class or a theme that's worked might not work. And they're very reluctant to change. So when something is working, folks are reluctant to change. They're not going to change something that's worked. When prices keep going up, what's worked keeps working. Now, what that leads to is when it goes the other way, when price goes down in the dumps, people feel worse, then they try to make a bunch of changes. And that's a horrible way to invest. You end up market timing, getting out when prices are down, piling into the best performing themes when prices are up. So this is going to fall on deaf ears, but now is the time to do the work. Now is the time to build a portfolio that fits your plan, that fits the way you feel about risk. Not wait till the market dies by 30% and you make a bunch of emotional changes. That's what we see time and time again. So a lot of the work that we do is on the behavioral side. We really try to unpack our clients' cognitive and emotional biases, unpack how they feel about risk. It's easy to be a risk-seeking investor when times are good. What we find is people are false risk-seeking investors. They take a bunch of risks during good times. The market turns. Oh, hey, I didn't mean to take that much risk. I didn't know I could lose 20%. And then they make a bunch of emotional changes. So we're just trying to get ahead of that.
Yeah, it's interesting. I find myself in meetings this year. Our portfolios have done quite well for a variety of reasons. Diversification has worked in 2025. But I almost find myself in these meetings with clients reminding them that the market goes both directions. And I don't know when that'll happen. And I feel kind of guilty is not the right word, but I just want to try to keep people on a more even keel.
Sure.
When things are good, just understand that that won't always be the case. And when things are terrible, that won't always be the case either. So trying to help clients maintain an even keel is what I find myself doing.
Well, and perception of risk can ebb and flow. When markets are trending higher, folks think it's less risky at that point, right? Hey, prices are, the S&P's been up in 23 and 24. It's had a good year in 25. It's all clear. I can put cash to work. And then when the markets are down by 20, 30%, people think, oh, markets are full of risk. But it's actually the opposite. Like, your margin of safety is much higher when prices are lower, when things are beaten down, when stocks are out of favor. That's usually been a pretty good time to invest. And I've written many blogs about this, but there's few fat pitches in investing. Investing in a crisis market, putting cash to work in a crisis market environment is one of the few fat pitches that investors get. Most just watch the pitch go by.
Yeah. Okay, I've got a little bit off the tangent for you here. I've got two subjects, and you can pick which one you want to weigh in on.
Okay.
Okay? 50-year mortgages. That's been in the news lately. That's a suggestion Trump's considering whether to kind of push the housing market to 50-year mortgages. That's one. The other is the potential for tariff stimulus checks. So a stimmy check, couple $1,000s to everybody because of how wonderful the tariffs and how much money the tariffs are bringing in. You can pick either of those subjects and weigh in on it.
This feels like entrapment. I'd say 50-year mortgages are probably good for banks, not so good for the consumer. I mean, that's basically a debt noose around your neck for most of your adult life. And when you have a debt noose around your neck, it just restricts you from doing things. Like when I started Pure, I had a mortgage. I sold my house. I wanted to get rid of the mortgage, and I moved into an apartment to make sure it worked out. So debt really is a restriction to risk-taking, to the entrepreneurial spirit that this country was built on. So, I mean, the main problem is we don't have enough housing. We just do not have enough housing. So I would say rather than a 50-year mortgage, let's cut out all the regulations, the red tape, the zoning stuff, and let's just build more affordable housing or more housing, which would, more supply, price should go down. Your second question was on tariff dividends. That sounds good in theory, but if we're trying to get inflation down, giving people more money to go out and spend probably doesn't achieve that goal. I'd rather see us use excess revenue, tariffs to pay down the debt. We're at $38 trillion, which is a number so big, humans can't even wrap their heads around that.
Yeah, it goes back to a couple of years ago when some states were proposing an inflation hickory. And like, hey, inflation's so bad, let's give you a couple $1,000s. And to your point, that's great in theory, but that money gets spent and then inflation tends to move higher. So not sure either of those ideas are going to be helpful in the long run. Easy for me to say.
Well, and these takes aren't political. This is economics 101. The more money you have chasing a fixed amount of goods, the higher the price of those goods. So I'm not sure more money is the solution to quelling inflation, which has been a problem for a lot of folks.
I've got one more for you when you're ready.
I've got a stat that kind of blew my mind. So when ChatGPT first launched, there were 4 companies that were worth $1 trillion or more: Microsoft, Apple, Google, and Amazon. Now there are 9, and 4 of them are in the $3 trillion club. Any reaction to that statement?
Not a ton of surprise, because it goes along with the theme we talked about earlier, which is the market has moved higher and higher and higher, and the AI companies have moved higher and higher and higher. And the AI companies that have benefited the most are not small companies. They're the companies that have the cash flow to put towards AI initiatives. So the NVIDIAs, the Metas, companies like that. So I'm not surprised that the bigger companies have gotten even bigger, but obviously the numbers are a little bit staggering and take you back a little bit.
Yeah, that's quite the concentration in wealth. And I struggle with the whole human side of AI. And I've said this a few times, but it's off the record. So this isn't what Pure thinks. This is what I think. I think there's going to be a backlash from a consumer standpoint and an investment standpoint in companies that replace human workers with robots and AI. So similar to an ESG factor where someone might say, I'm not owning companies that promote alcohol sales or gun sales or gambling. I think investors could shun companies that reduce headcount in favor of AI. And people talk about the gap between the haves and the have-nots. If these companies continue to get bigger, if humans lose their jobs to technology, that's further going to concentrate wealth. And I don't see how that's a good thing for anybody. So again, we talk about AI a lot. And it's an interesting debate because there's the investment thesis of it. There's the human side. There's the social contract side. So there's so many layers to this, which is why it's so intriguing.
The last question I have for you, and this is basically, we have internal discussions, debates all the time, but you might share your thoughts on how you see the future of financial advice and how you see this playing out over the next 2, 3, 5 years. We've talked about AI. AI could be a component of that. But how do you see the future of advice moving forward for everyone?
That's a good question. We've tried to position Pure Portfolios to stay ahead of trends. And I think there's a few things that stick out. People want advice. They don't want to pay up for it. So a lot of these legacy advisors, Wall Street firms, still charge 1 to 1.5%. They still use expensive solutions to build out the portfolios, like mutual funds, like alternative assets, like private equity. So the all-in cost of investing is still pretty high with a lot of the legacy players. So we've tried to lower the overall cost of advice. And then the technology stack. So I came from a large bank, a legacy bank that had bought many other banks. And it's amazing to me that we've been able to build a very superior and compelling tech stack, given that our budget is much smaller. We're an independent company. We don't have billions of dollars that are backing us. But what we've been able to build, I would put up against anyone from a technology standpoint. We've got an AI tax tool. We've got a digital estate planning partner. We've got an elite planning offering, modeling cash flows, mapping out retirement planning. Our portfolio accounting software is best in class. So what I'm saying is a lower fee fiduciary advisor with credentialed human beings that are good at financial planning, that have experience in investment management, powered by technology. That is the future. We've tried to get ahead of this, and I think we're ahead of most. And as we evolve and as we mature as a company, we're going to continue to invest in the client experience, continue to invest in our people, continue to invest in the tech stack. It's not, oh, we're 100% planners, we're 100% investment people. We've got an open mind. Just because our industry has offered a certain offering of services doesn't mean that's always going to be the case. We continue to invest and push the envelope because what people want, what people need is going to change as things evolve. Like what a 45-year-old is looking for is going to be different than what a 70-year-old retiree is going to be looking for. So we want to be able to offer services and experiences that fit multiple demographics.
And what role do you see AI playing in that, if any? We've started to see certain startup advisory firms that are 100% AI or however they market it. But how do you see AI playing into the future of financial advice, if you do?
Yeah, and I can tell you how we use AI at Pure, and it's basically touches every part of our business. I use it for investment research. I use it to dissect prospective client portfolios, so I can load in a statement to our AI tool. It aggregates everything by account. I can see exposures, across multiple accounts. I can see back-tested performance. I can see fees. I can see everything, and it's been a pretty powerful tool for us. We've got an AI note-taking tool, so I can actually see at the end of a meeting, a prospect meeting, a client meeting, outlines bullet points, the high-level summary, crafts a follow-up email. I know our compliance team uses it to scrub compliance documents, legal documents. So one of our associates has started to develop AI tools, a sequence of return risk tool, a cost of investing tool. These are proprietary tools with Pure branding that we've created using AI. And then for some, obscure, like we have clients in 24 states. Sometimes it's nice to be able to get on an AI chat model and just look up state-specific stuff like estate planning thresholds, stuff that we're not well-versed in, which is nice. Of course, you need to verify it, but it's nice to be able to quickly access that data.
And I think we've talked about this before, but maybe we wrap up with, what are some of the add-on services or additional tools that we hope to be able to bring to clients as we move forward 2026 and beyond? What are some things on your mind that you're hoping that we get the ability to deliver?
So we've been trying to solve for proactive tax advice and then also trust and estate advice. A lot of our clients are over their state's estate tax threshold, meaning, God forbid, if they passed on, they have assets in such that they would owe a state estate tax. It's kind of a clumsy thing to say. So looking to set up trust, looking to do more intentional giving, looking to get ahead of that, because most people want to pass their funds onto their heirs or pass their assets onto their heirs without punting a bunch of money to the state in which they live. The other challenge that we ran into was, I'd say half of our clients are looking for a new CPA. They can't find CPAs because young people don't want to be CPAs. Many older CPAs are retiring, so there's really a lack of supply of CPAs. So being able to bring that in-house is something that we've been working on, and we've tried to use third parties and consultants and things of that nature. It just hasn't worked out. So we hope in the first half of 2026 to be able to offer in-house CPAs, both to do client taxes and give proactive planning advice, and then also have a mechanism to offer trust and estate planning advice.
That's all I had on my list. Anything from you?
I should have asked you more questions, but I didn't. We're running up on 30 minutes. I wish everyone a happy Thanksgiving. Most of you will get this around Thanksgiving, and then we will see you in December. Thanks for tuning in.
Cheers.